fears of the property bubble are back. It's a new year and the naysayers are out, the property pessimists are out, the negative Nellies are out, telling us we've got a property bubble. So that's what we're going to unpack today as I chat with Pete Wargent to help you understand what's really going on. Now, if you've been following these podcasts, you know I'm still away on vacation and we recorded this just before the Christmas break, but the information is very relevant because one of my, late New Year's predictions is that there's going to be a lot more negative Nellies and pessimists out there telling you that if the property market keeps growing like it has and wages don't grow, that we're going to have another property bubble. Now, we know the government, the regulators, the Reserve Bank were all hoping for an orderly upturn in housing prices. But last year was anything but normal. We've actually had a very strong recovery in Melbourne and Sydney, the two property markets where property values fell the most. Now, prices aren't spinning out of control, but first home buyers are back, established homeowners are back, investors are back, because they're fearing of missing out, particularly in the two big capital cities, and a number of interest rate cuts, freer lending, and a media that's much more friendly to property has been encouraging people to get into the property market. Now, the more stringent lending criteria by the banks is still making it hard for some, but they are loosening the screws a bit. And we know the Reserve Bank's got its own agenda. It really wants to kickstart consumer demand. It wants to kickstart investment, not property investment, but investment in the economy. It wants to reduce unemployment. It wants to increase inflation. So it's got this difficult balancing act of lowering interest rates without accelerating the property market too much. So has it got it wrong? Are we in a property bubble? That's what we're going to talk about, particularly at a time when we're going to run into a period of lower supply when there's increased demand. So lots to discuss in today's show. At the end, I'm going to give you some information about how you can spend some time with me understanding exactly what's happening in our property markets in my annual Property and Economic Market Update seminars that I'm going to be running around Australia. But first of all, let's have a chat with Pete Wargent and talk about the fictional, mythical Australian property bubble. Welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
Unlike the stock market, where most people understand and they accept that the risk of the price of their stocks is going to fall, when most people buy homes, they don't ever think the value of their home or their property investment is going to decrease. For years, we've been debating whether the booming property markets in many cities around Australia have meant we're in a housing bubble. And now that the markets have started to rebound, the property pessimists are out there again, and they're saying we're going to have a housing bubble, we're in a debt bubble, and it's going to burst. So are we just kidding ourselves? Is the bubble going to burst? I'm going to have a chat today with Pete Wargent, one of Australia's most respected financial and housing market analysts, to unpack this story and let you know what's really going on. Welcome, Pete.
Pleasure, Michael. Always good to be here.
Well, you're one of our most regular guests now, and I have fun talking about these in-depth topics with you. So let's start with the elephant in the room. What is a bubble?
Well, I suppose the bubble doesn't have a set definition, of course, which is one of the main challenges with identifying them. I suppose the original bubble was the South Sea bubble way back a few centuries ago, where values of those companies were being bid up on false underlying expectations. But I suppose the most popular definition is really when there's a lot of speculation based on buying something today that'll be worth more tomorrow, but without anything sort of underneath the asset value to support the valuation. So But as you said, very popular now, bubble spotting, particularly since the financial crisis. It's almost become a national obsession.
Well, interestingly, I first came across the concept of bubbles with the South Sea bubble, the tulip bubble, where people push the price of tulips up. Some of us will remember the tech bubble, where people were paying horrendous prices for stocks in tech companies that were never going to make money, and then that crashed. So with regard to housing, I guess most people, like you say, there isn't a definition of what constitutes a bubble, but where there's a big jump in housing demand, without the underlying reasons for it, and especially when there's lots of speculators hopping in, hoping to make a quick buck. And so that's why I can understand that maybe 3 years ago, when 50% of people buying properties in Sydney were investors, we were in a speculative rising market. But I guess the other definition of a bubble, or the thought behind it, is it's going to burst. In other words, it's going to suddenly deflate and values are going to drop. But I know as a technical person, you've also understood the concept that the market should understand what's going on in prices. There's this efficient market hypothesis.
Yeah, so gosh, there's a few different things to cover off there. Luckily, we've got a bit of time today. So yeah, you're right. The efficient market hypothesis basically holds that assets are fairly priced. So all known information is priced in to an asset. And now you and I have been investing in property a long time, and we know that by and large markets are fairly efficient. So high-rise apartments tend to underperform. People place a great deal of value on scarcity. But that said, there's still a property cycle. So back in 2017, we saw a lot of the indicators that we were heading towards the peak of a market. There were lots of new entrants to the real estate industry. There were people paying over the odds or over bidding too high at auction. So there are certainly indicators of a cycle, but actually identifying a bubble is much more difficult. So you mentioned, for example, the tech bubble. That's a great example of something that everybody knows was a bubble. But even there, where people are starting to talk about the tech bubble around 1996, when the Nasdaq was just over 1,000. And it ran out all the way up to, around about 5,000 for a few days at the peak there. So whether or not people can actually identify bubbles in real time is another question. And in fact, if you look at the Nasdaq today, it's well over 8,000. So was it a bubble when it was at 1,000? Not really. The internet has changed the world. It's just some of those companies were never going to make the grade. So there's lots of different moving parts, but people's ability to identify bubbles in real time is very questionable.
Clearly, otherwise they wouldn't get involved unless they were speculators. So people have been saying house prices are rising at a rate that doesn't have underlying fundamentals. They're suggesting that's one of the reasons why we're in a bubble. So what causes house prices to go up, Pete?
Well, I suppose the classic answer is always supply and demand. And there are many different ways you can try and attribute a fair value to housing. In Australia, typically, because we all live in just a handful of areas, essentially Sydney, Melbourne, southeast Queensland predominantly, generally people, if they can borrow more, if they can afford to pay more, they generally do. And so one of the ways that I try to look at identify what might be a fair value for housing, it's just looking at how much interest people are paying on their mortgages. And if you went back to 1989, people were paying about, on average across Australia, about 10% of their income on interest. By 2008, it was up to, 13 or above. And today it's back down to well under 10. So if you actually look at mortgage serviceability, housing prices have done almost exactly what you would expect them to. Now, of course, there are other measures you could look at and say in some areas prices are overvalued, but it's been a pretty rubbish way for people to approach housing, sort of talking about bubbles, as you mentioned, for at least, 16 years that I can remember in Australia. And through that time, we've just gone through cycles rather than bubbles.
One has to remember that it's home buyers who make the property market up. 70% of Australians own their own homes. Sure, they've got a mortgage against it. So it's only the investor market that drives the booms, drives the downturns a little bit when they come into the market or they disappear from the market a bit. But Australia's property markets are underpinned by homeowners who own a property that they're not going to sell, even if the market turns down. So I can't see a large element of speculation in the market in general. And then, of course, we know that while people are talking about debt, if you take into account that there's close to $7 trillion worth of property in Australia and $1.9 trillion worth of debt against those in all the banks and the mortgages, our loan-to-value ratios on the residential real estate markets, less than 30%. It's about 27, 28%. So the debt is tending to be in the hands of people who can afford it. And currently it's easier than ever to afford debt, Pete.
Yeah, so I think, I suppose if you were saying, well, what are the actual indicators of a bubble? I think if you went back to 2017, I think it would be fair to say, particularly in Sydney, to a certain extent Melbourne, we did see there was a big rise in the number of availability entrepreneurs, people who are, there were gym instructors one day and real estate advisors the next. There was some of that going on, and there was definitely some frenzied activity at auctions. There was expectation of fast gains. We definitely had some of that. And one of the things you always see in cycles, and you'll know this better than me because you've been through more cycles, there was overbuilding. There was some poor lending standards. There was good examples of that came out in the Royal Commission. So lots of the things you would attribute to the peak of a property cycle. But a lot of those things have now gone away. We're not overbuilding anymore. A lot of people who came into real estate as a new career, in 2015, 16, 17 have now departed or gone off to do other things. The lending standards have been tightened up dramatically, if not too much in some cases. And the frenzy, well, we had 2 years there where transaction levels were actually at the lowest level in a couple of decades. So, yeah, it's I would say that is much more like a cycle rather than a bubble. There's people love to identify bubbles. It makes you feel sophisticated, and you can never be proven wrong because there's always tomorrow when you might be right. But the reality is that most of the people who spend their time spotting bubbles, be it in Bitcoin or Canadian real estate, they very rarely seem to get the timing right, and it might make them feel good, but it doesn't always yield great results.
So I guess what you're saying is the property market cycle is what we've been seeing as opposed to a hyperinflation of property prices, which you'd see in a bubble. So, yeah, that last cycle, we went through it finishing in the middle of 2017. And similarly, when there was one at the beginning of this decade, 2011, 12, and I remember them in previous cycles, they were always associated with a general economic upturn. People felt prosperous, people felt well, they had high disposable income. It was also driven partly by population growth and a demographic segment of the population that are wanting to enter housing because more of our immigrants are at household formation age. It often started with low levels of interest rates. And you mentioned about the poor lending practices, Pete. I've seen that at the boom stage of every other property cycle. So I'm talking more about property cycles, not bubbles, because what I think we did was just have a normal property cycle. I remember there were some innovative mortgage products that came out before the global financial crisis in 2007 and 8. And if they hadn't been stopped, boy, we could have gotten to the same problems they did overseas. You may remember that not just no-doc loans, but cash flow loans. So you didn't even have to document how you could afford to repay the loans. And there's usually at the boom stage of the cycle easier credit. So people could borrow more than maybe they could have earlier in the cycle. And that creates the boom. And interestingly, I believe the market tends to correct itself. And it has this time round. It's usually either the Reserve Bank raising interest rates, or in this case, it was APRA tightening credit. So the government has slowed us down and the cycle started all over again, Pete.
Yeah, that's right. And I think, as we touched on earlier, I think what you generally find is that From day to day and week to week, it's easy to find imperfections in the property market. We see it, you guys see it at Metropole because you're active in the market day in, day out. It's easy to find imperfections, but most of the time the market is fairly priced. It's People don't give away assets for less than they're worth, and the market does place a great value on scarcity. So if you've got a good block of land or a good medium density property in an area where there is scarcity and a lack of supply, then the market places a great value on that, and that's why you always emphasize that you invest through a cycle in assets that have scarcity. And if you stick to those fundamentals, you'll do just fine. It's when people stray too far from those fundamentals that they can come unstuck. And in the most recent cycle, it was people buying off the plan, in poor locations and in buildings of sometimes questionable quality. Those are the people that get caught out. So always bring it back to the fundamentals of good investing.
Sure. So that's the cycle in action, but that's not a bubble bursting. Property values did drop up to 15% in Sydney, 10, 11% in Melbourne, but they're now working back, correcting some of those losses. So why do we love to call everything a bubble these days? Why are there so many doomsayers around, Pete?
It makes people feel sophisticated, for one thing. Being contrarian, it makes you feel smarter than the crowd. And it's a bit like when other people are enjoying themselves at a party. There's a certain righteousness in telling other people that they shouldn't be doing what they're doing. But there's also, undoubtedly, it's difficult. There was an old saying that a bubble is just a bull market that you've failed to invest in, and there's certainly an element to that too. I'm pretty sure if you went back through the online commentary, I'm sure at some points along the line I said that Bitcoin was, it was unsustainable and it was never going to keep going up. But I was probably 2 or 3 years too early, which is another thing that happens with bubbles. But I suppose as well, since the financial crisis, everybody has become a hindsight expert in explaining what happened in the US through the subprime issue. And with online media, of course, there's a great deal of interesting clicks to be generated by talking about bubbles. But if you look at most people's track record of actually identifying and profiting from bubbles, you would find it's a tiny, tiny minority.
Well, they say yes, but I'm not talking necessarily about this year. We've just, the Reserve Bank has kicked the can down the road and it's going to happen further on. And I know that they're out there again. We don't necessarily have to name the local ones and give them extra publicity, but I believe one of the overseas guys is coming back too, Harry Dent.
Yeah, I think both you and I have had some interaction over the years. I think it was 2011 when he was over in Australia predicting a 55% crash. And I suppose that is one of the things with the calling of a bubble, is that you can never be proven wrong because people just come back and say, oh, well, I wasn't wrong, I was just early. But of course, when it comes to investing and managing your money, being too early is as good as being wrong. But we've basically been through the property correction in Australia now. The market turned essentially immediately after the election. You would have seen that at Metropole, very quiet in the lead up to the election. We had essentially 2 years where the market slowly deflated and there was a lot of caution around. But now we've come out the other end of the cycle. And I think by 2021, we'll be talking about a structural undersupply of dwellings again, because people have become naturally much more cautious about buying off the plan apartments. So the cycles repeat. The specifics may be a little bit different in each cycle, but it just keeps on going around.
Yeah, clearly I agree with what you're saying, but there's probably somebody in our large audience listening to you and me right now saying, what if they're wrong? What if there is a price drop? What's going to happen next?
Well, for one thing, when it comes to real estate, you don't buy the market. So it comes down to good asset selection for one thing, because as we probably see in every cycle, but as we certainly learned in this cycle, not every property performs the same in the downturn. Obviously, there are fewer buyers around, but if you bought the wrong type of asset, then that can really catch people out. So that's one thing. Another thing is that real estate is really not a short-term investment. You shouldn't be buying with an expectation that prices will be much more in a year's time or 2 years' time. You need to really be looking at investing through a cycle. And also, as you already mentioned, the real estate as an asset class, it's not made up of purely investors as other asset classes are. It's really driven by home buyers, and the government has pretty much signalled that it wants a 10% rise in house prices this year. So it will do. It seems to be doing what it can to squeeze interest rates lower. They'll introduce a deposit scheme to bring first home buyers into the market from January. So I think a lot of these forecasts, if you went back to the start of 2019, I was actually hauled into the media to talk about, should people put off buying a property until next year? And they're very difficult questions to answer, but I said no. Here's a 2-year downturn. These opportunities only come around so often, and if you wait until 2021, you'll be paying more. So obviously, individual circumstances apply. We've got low interest rates. We've got a coalition government, which was a positive shock for the market. The lending standards have been loosened a little bit, and the pendulum's swinging now in the other direction.
But clearly, Pete, as you said, there's also a housing undersupply looming, because with our population growing at about 400,000 people a year, we're requiring about 150,000 new dwellings. And there's quite some lead time to create that big bulk in the large developments that the developers do in town or in the house and land package areas. And at the moment, there's reticence for people to buy those. So we've got a few things to work through, and the supply-demand ratio is probably going to work nicely in the favour of those people who own well-located properties. So looking forward, where do you see properties? Because this is going to come up a lot soon. We're at the end of one decade, the beginning of another one, and people are going to wonder, well, where are things going to be in 10 years' time?
Well, I think the economy has been pretty slow now for 12 months, but you need to remember that what gets reported in terms of growth in the economy, that relates to what happened over the past year. It doesn't mean what's going to happen going forward. And that was really driven by the credit squeeze, which has now ended. So if you look at housing finance month on month, it's ripping higher. So I think there will be some challenges for the economy. Got to get unemployment down a bit to get wages growing. I suspect at some point the iron ore price will come down. But essentially, if you look at what's in store for the next decade, if you look at what financial markets are suggesting, we'll have the lowest interest rates we've ever seen through a cycle. And that's positive for asset prices. The economy will have its ups and downs, but it will continue to grow. Population, I expect over the next 10 years, will grow by about 4 million. So if you're looking at fundamentals for property, if you own property in the right locations, I suspect there'll be another generation of people who profit handsomely from real estate. But as always, look at where people are moving and buy the land before they get there, as the old saying goes.
Makes a lot of sense. So we've got some interesting times ahead, some challenges and some opportunities, but that's no different from any other year. It's no different from any other decade. And I think what we've both been saying is the property market is doing its thing. It's running its normal cycle. It's moving ahead now. No debt bubble, and we discussed that in different podcasts, because there's minimal housing mortgage stress and defaults. No property bubble, because property prices are sounding to be fair at the moment. So good times ahead. Thank you very much, Pete. Now, I know that you write regularly on Property Update, but if people want to get more of your great content, what's the best way they can get in contact with you?
2 easy ways. So my daily blog is just Pete Wargent Blogspot, really easy to find. And if you enjoy some videos instead, I put plenty of content out as well, all for free at gonextlevelwealth.com.au.
Fantastic. I look forward to catching up with you again real soon. And next time, Pete, I'd actually like to have a chat about the property market versus the share market, because both you and I invest in both. A lot of people think that we're biased to property. We're not actually biased to a individual investment class. We're just biased to getting good returns, aren't we?
Yeah, that's right. It's really a function of the tax policy in this country. Property and shares are where the most favourably treated asset classes lie. So it's good to have a balance of both, and they both do different things for your portfolio. So I look forward to that chat.
Okay, we'll catch up in a couple of weeks and do it right then. Thanks, Pete.
Cheers, pleasure.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I'd like to discuss 7 things you can't control. You see, in this life, we all tend to get overwhelmed by things. That's not going to change. No matter what you do, how well you delegate, there's always going to be too much to do. So let's let go of some of the pressure by understanding some things you don't have control over. So 7 things you can't control. Number 1 is time. One day you're going to wake up and realize there's just not enough of it. So don't waste your time and energy on forced interactions with people you don't like or doing things that you don't like. Make best use of your time. The next thing you're going to realize you can't control is other people's reactions. So never trade your own personal authenticity for other people's approval. Trying to make everyone happy is a soul-draining exercise. It's only going to leave you feeling empty. Invest your energy in people that matter. The third thing you can't control is being richer than someone else. You're never going to be satisfied with more money. Money on its own is worthless. It's only valuable because it can get you something you want. As I've said before, any problem that money can solve isn't a problem. It's meant to be exchanged. So use it to connect with people and invest in experiences that you enjoy. But don't compare your wealth to anybody else. The fourth thing you can't control is you can't expect there's going to be one day when those who hurt you suddenly show up and apologize. So for you, holding on to anger is only prolonging your own pain, your own unhappiness. Learn to forgive. You deserve peace. So you're forgiving for you, not for them. Fifth thing you can't control is overthinking. Overthinking can create problems that aren't even there. So focus your imagination on things that are brilliant and that make you feel good. Another thing you can't control is the world around you. When I was young, I wanted to change the world. And then I realized the world changed when I did. Your outside world is a reflection of your inside world. Your thoughts lead to your feelings lead to your actions lead to your results. So the world around you can't be changed. But when you change, funny how so many other things are going to change. And the last thing, the seventh thing that you can't control is your past. You can't restart the next chapter of your life if you keep reading the last one. No matter how bad, difficult your past is, no matter how dirty your past is, your future is spotless. Thank your past for all the lessons and acknowledge how it strengthened you, how it's made you the person you are today. So today's mindset was to show you there are things you can't control. And rather than try to control them, let go, move on, enjoy this life. You deserve it. Well, now that you know there's not a property bubble ahead, what should you do to become more successful in property? Another early year prediction is there's going to be lots of mixed messages and there's going to be a whole range of new spruikers trying to take advantage of less experienced investors and grab their money and stop them growing the wealth that they deserve. So once a year, I conduct a series of seminars around Australia, and I'll be doing it in Brisbane, Sydney and Melbourne, together with local property experts and Dr. Andrew Wilson and Ken Race, my business partner at Metropole Wealth Advisory, to help you understand exactly what's ahead with some forecasts and some details, not just about those capital cities, but all of Australia. So if you want to understand what you should be doing and what you shouldn't be doing, where you should be investing, how you should be investing. I've been conducting these seminars now since 2000. I guess that makes it 20 years. I'm not sure that I don't think there is anyone else in Australia who's been conducting them that long. So they come with an impeccable track record. Go to propertymarketupdate.com.au and find out about when there's going to be one near you. Only one in each state, only once a year. And I'd love for you to attend propertymarketupdate.com.au so I can help you make the most of this new decade. And I'm going to do it twice a week through the Michael Yardney podcast and actually every day through my property update. And by the way, if you want to get even more of me, follow me on social media, Twitter, Facebook, YouTube, Instagram. I'm having a bit of fun with Instagram at the moment. As you know, I've pre-recorded this before I've gone away, but I bet you there's going to be lots of photos of our fantastic cruise while I'm away. So just look for Michael Yardney on social media. And if you liked the show, if you got some benefit, please share it with somebody. I want to make more people financially fluent to help them become more financially successful. And I'd like you to help me do that by just telling some people about it. Either tell them, use social media, do whatever you like. Press the share button on the podcast app and let some people know. And if you want to tell the world, why not leave a review on iTunes or Stitcher or Spotify, wherever you leave reviews. And I'm so pleased that we're continuously getting 5-star reviews. And I got one from Maddie Island. Oh, by the way, when you leave a review, and if I read it out, I'm going to gift you one of my books. All you've got to do is email me, michael@metropole.com.au, and I'll gift you one of my books. And Maddie Island left an Apple podcast review back last year in 2019, saying a wealth of knowledge. This podcast has such a wealth of knowledge for everything to do with investing, developing, manufacturing growth, and even the simple things like the habits of successful and rich. Oh, by the way, Maddie, they're not simple. Those habits are really critical. I stream this every day and even send it to my home loan manager, who also finds it amazing. Gee, that's really good that you're passing the message on. I really appreciate it. Whether you're already an investor or looking to start like I am, this podcast's all you need. Let Michael and his credible team like Ahmed Imam and Pete Wargent and Brett Warren and more expand your investing horizons. Maddie, when I read that, you really made my day. I very much appreciate it. I hope, as you're a beginner, this is going to point you in the right direction. And for the rest of us, I look forward to catching up with you again twice a week. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?